welcome to the Hive Live. My special guest is Andrew Roper. Andrew, I probably won't do any of this justice, but right off your social, Andrew is a mortgage arranger at Dominion Lending, business development specialist at CMI, and a business development manager at Industrial Alliance Financial Group. Did I get that right? Anything?
You got that right, yep.
I guess a good place, I know we have a little kind of presentation for us today, but could you let us know just a little bit about your background?
Certainly, by all means. So I started in the mortgage industry better part of 20 years ago. I started off at a small little independent firm and then moved to DLC. When I was at DLC, got the mortgage award and was nominated for the alternative broker of the year twice. From there, when the mortgage regulations changed with insured, uninsured, my whole business model kind of shifted, and I got headhunted by Industrial Alliance. So Industrial Alliance, for those of you who don't know, is an A lender, so very similar to Scotiabank, BMO, TD, things of this nature. I got headhunted by them as the business development manager to sort of ramp up their mortgage business. Worked with them for a better part of 2 years, and then they actually closed their entire mortgage division and stayed on in the insurance side. From there, I transitioned into the private sector. From the private sector, working with MICs and alternative lenders, things of this nature, doing the same thing as business development. Uh, Currently now I'm actually with Green Lending, and Green Lending is my wife's brokerage, which also operates as a alternative lender or a private lender. And been here ever since, been part of Green Lending. Well, my wife has owned it for almost 10 years, and I've been with her for 6, and officially part of Green Lending for 3.5.
I caught your presentation, obviously, a few months back.
Yes.
At the kick office there. I just thought it was great. I've seen variations of it before, but I really liked your approach, and that's why I wanted to bring you on today.
Perfect. I do appreciate it.
Yeah, letting the masses here know about what you guys are doing over there.
Excellent. Thank you. Thanks very much. So short and dirty, I don't actually have a formal presentation because there are so many different variables in the mortgage world, and as well into the private sector. But what I would like to do is sort of go over sort of high level private mortgages. One, as sort of doesn't always have the negative and the stress connotation that it does, once upon a time. And then as well as how investors can earn or retain earnings, or how they're protected in a mortgage or in a private mortgage. I'd be open to any questions at any time throughout. I would love and appreciate that. So if you guys have anything at all, just let me know, because it'd be helpful to know that I'm on the right path, and what you would like to learn.
Thanks, Andrew.
No worries. All right, where to start? So private mortgages are not only for individuals who have bruised or damaged credit or are losing their home. Of course, those are, some situations where a private mortgage could step in place. But essentially, what a private mortgage is it's individuals or a corporation who's chosen to invest in mortgages versus the stock market, RSPs, or GICs. So this is just another alternative for the investor to earn income, and then being as a mortgage, it's secured against the asset or secured against the house. So really, when you're a MIC or a mortgage investment corporation, essentially you're taking somebody's money and you have a preset determination of where your comfort zone is. So the person, for example, the end user, so myself, for example, I would say, okay, I'm going to invest $50,000 in ABC123 MIC, and I'm going to expect to get 8-10% return on my dollar based on the parameters that MIC has set out. So then, as a business development manager, sort of example, as myself as in sales role, my job is to go out to other mortgage brokers and solicit them for files that suit that need to then come back into the MIC, and then the MIC would then put it out into a mortgage. Excuse me, earn a little bit of return on there, and we are off to the races. The difference primarily between a MIC and an individual investor chooses basically they're their own bank. They're saying, you know what, yes or no, I'm not comfortable with this file. Yes or no, I'm comfortable in this parameter. But essentially they operate along the similar idea where the fact that they have a certain rate of return they have in their set in their mind where they want to get a return, but also at the same time a certain criteria of where their comfort zone is. So for example, somebody who lives and grew up and is in Toronto may not be comfortable lending in Sudbury versus somebody who owns and operates and works in Sudbury may be comfortable to invest in Sudbury. So this is where, you know, years of experience and years of being a mortgage broker or investment strategy, whatever you want to call it, you know, we develop this sort of network where, you know, if you're buying in Sudbury, you know, I'm looking for a lender who's comfortable, obviously, in Sudbury, and so on and so on. I know that sounds cliche, but at the same time, it's never more prominent than, especially in this market, as well as the fact that we just need to know who's comfortable where. And then also at the same time, you need to know, you know, parameters change. Like I'm sure in the last, you know, 2 years, you know, lending comfortability has changed. You know, where you're comfortable, how you're comfortable, things of this nature. So what's happened recently in a lot of the market right now is there's a lot of good clients that are being pushed into the private sector due to the tightening regulations that there are in the mortgage world. I'll just give you an example on my plate right now. We received a file this morning where we had credit scores that were really great. They're purchasing a pre-construction home, but they're both business for self, so they show very little income. They write most of it off. That's an excellent and an ideal client for a private mortgage because with a private mortgage, you're looking at it as, you know, am I going to get my payment? Am I going to get my money back? Now, as a private mortgage lender or an investor, you're looking at the whole picture of the file. So what I mean by that is you're looking at, you know, credit worthiness. Can they afford the payment? As well as the equity within the property. And you're really focusing on the equity within the property because you want to make sure if something happens that you're going to get your investment back. Is everybody familiar with how we figure out the equity within the property?
I do, but if you don't
No.
mind recapping, just in case.
Quick and dirty. So for example, the value of the property is $100,000 and you're comfortable going to 75 or 80% loan to value. Obviously, 80% would be $80,000. And then all the fees and everything that are associated with a mortgage or that investment is then deducted from the advance. So deducted from the $80,000. The client, the end user of the mortgage, is going to be paying for that that privilege or that right to get the mortgage. Now, loan to value is determined by several different things, or comfortability on the loan to value is determined by several things. You know, the quality of the home, where the home is located, the marketability of the home, the credit worthiness of the client, the income worthiness of the client. All these play factors in when you're investing in a mortgage so that you know whether or not you are comfortable to proceed forward. Um, as a lender, you know, each lender has their own sort of nuances, their own sort of idiosyncrasies, very similar to, you know, Scotiabank compared to TD Bank compared to BMO Bank. So we're all, you know, they all have different lending parameters, guidelines, things of this nature, and it's up to a good mortgage broker to figure out exactly what is right for the client. Especially in today's market with, you know, B lenders and A lenders and private lenders, they've never been so close as they are, you know, sort of within the rates and their asking qualifications. Let me just give you a scenario. If you have an A client that is on your plate, primarily the focus of that lender would be credit and income when they're looking at a home, and the home is the secondary aspect because usually that's back end insured through CMHC or Genworth Insurance, so that means that the lender is protected. In the alternative lender situation, you know, you're having the equity situation, you're having a slightly higher interest rate, but you're still focusing on the credit and the income of the client in order to qualify for that debt. The ratios are expanded a little bit, but you're still looking at that. On the private sector, you're looking at basically, does the client can they afford to make the payments? And realistically, you know, hey, we're renting out a room, we got contributory income from, you know, a boyfriend or a girlfriend who's not on title, mom and dad are helping out, whatever the case may be, or even we can use mom and dad's property as additional security if there's not enough equity in the subject property to proceed forward. And then the rates ranging are very different throughout the board. So let me just give you a scenario. In the A sector, you're probably looking in the mid to low fives. There's some lenders out there that are in the high fours right now if you're back end insured. B lenders, you're looking at, sort of mid sixes to about, mid to high sevens, depending on where the property is and where, the credit worthiness of the client and whether it's a purchase or a refinance. And then in the private sector, you're ranging anywhere from about 8 to about 11% for first mortgages. And second, you're looking at anywhere from about 12 to about 15 with an additional lender fee. So an ROI is tacked on to that. Dave, do you think we should touch into what it would take to be an investor in a mortgage?
Yeah, that was a big piece I was hoping we could chat about.
Okay, perfect. So being an investor in a mortgage essentially have a couple different options. You can give your money to a MIC or a REIT. A MIC would be a mortgage investment corporation. A REIT would be a real estate investment trust. And so you'd be giving your money to, for example, CMI is a big one. Canadian Mortgage Inc. You give your money to Canadian Mortgage Inc. They would then in turn put their money out for the files that are coming in, and you would get a flat return on your dollar. A REIT operates very similar. A REIT does more of, like, for example, plazas, things of this nature. I'm not sure if you've ever seen like RioCan, that would be an example of a REIT. And then an individual. So an individual would be like, for example, myself or David, who chose to invest in mortgages that would have a little bit better, uh, you know, a little bit higher net worth. And those individuals can then, put their money out in a mortgage and they can operate in one of two things. They can operate it as I'm going to manage and trust the funds myself, meaning collect the checks. And if it ever goes into default, then I address it at that time. Or they can give their money to an administration, very similar, with the exception that the administration collects the sort of administration like green lending, like what I work for right now, and they would collect the money on the client's behalf. And then if anything was to happen, meaning missed payments or late fees, things of that nature, then they would go after the client on your behalf so that you don't have to worry about administrating your funds. So the slight differences in the returns for the end user is sort of a MIC on a REIT, because they're more pooling their funds. They're more, the risk tolerance is a little bit lower. Your return on your dollar is a little bit lower. As for a administration aspect, it'd be slightly higher, but not as high as if you manage the money yourself. Okay. And if we're talking about, numbers and cents here, we're talking maybe the difference between a 2 to a 3% return difference on your dollar. Not overall return difference, but I mean, for example, like on a MIC, you might get a 8, for example, and if you manage the money on yourself, you might get a 10 to or 11% return on your dollar for exactly the same file.
Do you do both types of those loans over at Green Lending?
We do. As being a mortgage brokerage, we have to sort of, we can't just, tie ourselves to one individual lender. So when we have files coming across our desk, we have the end user who are, our brokers at Green Lending operate, and they, handle the clients on a straightforward basis. Hey, Mr. Dave, you need a mortgage. Here's how we would be able to help you out, and go from there. So we would be able to, be a or taking you into the private sector, and then which private lender would be suited best for you. But we also have mortgage brokers who send files into Green Lending directly as an administration. So those would be treated a little bit differently. Those going through the administration, then we go out to the investors that we already have in our investor pool, and those investor pools would then we pool the money together, and then we put it out as a rate of return. To bring investors in, we do offer a compensation model for our investment managers who pool or find investors, so to speak. Then the investors would then go through sort of an underwriting guideline of what they would be comfortable to put their money in, what type of files they would be interested in putting their investment in. And then when we have a file that comes across our desk that way, then we shop it out to them. We answer any of their questions based on the underwriter's criteria that we have preset. And if that investor is then agreeable or comfortable to proceed forward, then we would administer and manage their funds from there. We do also deal with end users. What I mean by end users, investors who do have their own funds. Primarily, the reason why is because as an administration, you don't want to keep money on your shelf. So that, for example, a MIC. A MIC would be, I have, $10 million sitting in my bank account that I got to put out into mortgages. Well, if I don't have $10 million of mortgages coming into my MIC, then unfortunately I would have to still pay my investors on that money that's sitting in my bank account. Operating as an administration, essentially, when a file comes in, that's when we go looking for the money. So we have a pool of investors who are sitting there basically waiting to give us their money, and then we, basically introduce them to a deal, sort of like a matchmaking system.
If somebody was interested in lending,
Yes.
the process from the moment they maybe take the first meeting to, the process they have to go through up through, I guess advancing the funds through to the end of the term. Because I know some of the answers to this, but if you could outline from.
Absolutely, absolutely. Yeah, I'll give you a quick high. Yeah, no worries, Dave. Give you a quick high level. So, being an investor coming in, so we would go through a very similar process. It would be as if you actually applied for a mortgage. We're getting to know each other. So you get to know us, meaning, we tell you a little bit about our process. We tell you about, the types of files that we're looking for, the types of files that we would be comfortable underwriting for you on your behalf. And then you tell us, exactly the same thing. What type of files, if you've done anything in the past, what type of files you'd be interested in and where your comfort zone is. We also talk about, based on the market, the estimated rate of return that you'd be getting on your files. We also look at your credit worthiness and your income worthiness to be able to support the debt on your own, or if we're required to sort of cover any cost of that ourselves. When we actually have a file coming across our desk, so once we've actually agreed that we're going to work together, once we have a file that comes across our desk, we underwrite the file and answer any or ask and find out any information that we deem would be necessary for the file. So, for example, if the client's looking for, best example would be the one that I was working on just before this meeting. Client is requiring a second mortgage. So we looked at their credit situation. There was a couple questions based on their credit, so I sent it back to the originating broker. But essentially, the bottom line is the client was looking for a second mortgage because they have a great first mortgage interest rate. Their first mortgage interest rate is sub 3%. It's going to be renewing in the next year and a half. Getting them their credit has dropped a little bit. The second mortgage is then essentially going to be paying off their debt to a zero balance, which will then increase their credit. So that gives me a clear exit out from the file, meaning they're going to be out of the private mortgage. At this point, their credit would, a year from now, their credit would have increased based on the income on the application. They should be able to qualify through an alternative lender, alternative being like Home Trust, Equitable Trust, Desjardins, NPX, could name a couple. So the client has a clear exit from there as long as we don't have a drop in values. Again, the loan to value based on what the client feels the home is good to go. So I sent over, who we would like to use as an appraiser in that file. We gave a estimated price point based on the documentation that was submitted already, which of course can change based on the documentation that do come in. We do ask that the clients are up to date on their income tax, because if they're behind on their income tax, then that can actually jump to first position or ahead of us in the mortgage situation. So we want to make sure NOAs are up to date and in good standings. If the client's business for self, we want to make sure that HST and tax filings are up to date. If they're not up to date, we want an explanation why and what's going on, or how, or where's the solution on going from it. But then we'll be pricing that file accordingly. So then we sent that file back. So then once the broker has essentially sold the pricing and the terms and conditions to the end user, so the client, then they would come back to us and say, okay, yeah, we're good to go, issue a commitment. We issue a commitment. At this point, essentially, we have a further conversation with our potential investors and say, hey, this is the file that's coming forward. These are the 3, 4, 5 pieces of documentation that are still outstanding. We'll have this in before we actually move to fruition. Once we get the sort of file complete and we're good to go, a retainer is requested from the client to give to the lawyer's office, so the lawyer can do the searches and everything that is necessary to make sure that, yes, the mortgage is correct and, it's stated on the application and the mortgage statement. Yes, there's no outstanding judgments or liens against the client and or the property. Property taxes are X, the home is zoned Y, all the necessary indications to make sure that everything is okay, and then they forward instructions over to the client's lawyer. With every mortgage transaction, there is two lawyers. Now, the only time that there can actually be one lawyer for the transaction is when the mortgage amount is $75,000 or lower. Personally, and our practice here at Green Lending is we like to keep that threshold period. We like to have two lawyers for independent legal advice, regardless of the mortgage amount, just to give us a warm, fuzzy feeling and make sure our investors are protected. Once the instructions have been sent to the client's lawyer, we reach out to our investor simultaneously because now we're about 2 to 3 days prior to actually closing on the mortgage. Reach out to our investors and say, hey, this file is moving forward. Please transfer the funds into our account. So we transfer the funds into Green Lending's trust account. Once they're transferred all into the trust account, and our lawyer has received the necessary documentation from the client's lawyer, and this would be, signing of the docs at the lawyer's, ID, just like on a regular purchase closing or refinance closing. Our lawyer has confirmed that they've received the documentation. We forward everything over to the lender's lawyer, our lender's lawyer. They forward everything over to the client's lawyer, and we close the transaction. So when we're dealing through the administration, we have a pre-authorized debit form. So we collect the payments on the client's behalf, and then we give it back to the investors. So we try to collect everything on the 1st of the month and have it to the investors on the 15th. If the investor has chosen a different payment method or a different course, then we adjust accordingly. Or if the client, for example, has adjusted, or say they only get paid once a month, so then we would try to coordinate to when that payment would be coming out of their accounts, so then we can accommodate on both sides. The last thing we want is a missed payment. It does happen, but that's the last thing we want. Speaking of missed payments, if there ever is a missed payment, then we take it upon ourselves as administration. We go after the client, so it's call, text, email for the client to try to, hey, what happened? If it's 15 days after and still no response, or the client hasn't given us any indication that they're making a payment, or they've been making empty promises and it hasn't come through, then that's when we issue a demand letter. We don't mess around. We go after them right away. I know it's a little bit harsh, but at the same time, we're equity-based lenders, so we have to protect our interest. Once we actually send a demand letter, if it's still ignored, then we continue on in the process of power sale or foreclosure, depending on the situation. If we're in second mortgage position, then we check out, we confirm that the first is still up to date and good standings. We confirm that the property taxes are up to date and good standings. We confirm that the insurance is up to date and good standings. If either one of these are awry, we add this to our demand letter and then, ask the client to, make us whole. If the client makes us whole and we're still in term, then we can still proceed forward. Excuse me, if we're not in term and we're coming to the end, then we back out of the transaction and we continue moving forward with the foreclosure of the power sale. If we move forward with the foreclosure of the power of sale, essentially we're in second position, as in this particular example, we usually keep the first up to date and in good standing, especially if it's a bank, because they have a lower interest rate, but then we can still charge our second mortgage interest rate for those payments and everything associated in the costing with the file. If it's an alternative or a B lender, usually we pay out the first mortgage and then, assume the whole risk ourselves. It's a better protection in the long run for our investors. If we have to take back the property legally, we have to sell it at market value. So this is where we have to do appraisals on the property to determine the value of the property, and then we have to make our best effort to try to sell it at at value. Depending on where the source of funds come in is depending on who the realtor is that we choose to come into that transaction at that time. Our relationship with KIC has been fantastic in that department, so just that's been awesome. Okay, so we've taken back the property in our foreclosure. We put it up for sale. Now, in a couple different scenarios, so we can help. I don't want to say manufacture a sale, but we can help with a sale because we're an equity lender, but we also, because we are investors in real estate, we can help with making a sale happen. So, of course, if we have somebody who's going to purchase the property and take the entire equity or the entire property off our books, that is ideal. But in a lot of situations, we're able to sort of replace or make financing happen. I'll give you a scenario of that a little bit later. Once the sale happens in the property, everybody gets paid off, minus the costs and the fees, and if anything's left over, it would be going to the original owner of the property. Now, if none of this happens and everybody makes their payments and on time and everything's fantastic and it's in a perfect world, then at the approximately 3 months prior to renewal, we reach out to the investors and sort of say, hey, are you guys comfortable to stay on if the renewal option comes in? We talk about what the rates are doing at that time, what your renewal fee would be, things of this nature, so you can reassess and what your renewal options would be. Then we reach out to the client. So the end user, okay, your mortgage is coming up for renewal in the next 3 months. Are you wanting to renew? Or are you going to be paying us off? We reach out to the originating broker who sent us in the file. Are you still in business? Are you going to be refinancing the client? What's the situation? We reach out on a weekly basis, depending on whether we've heard from them or not, just to make sure that we get answers. After about 30 days, if we still, like 30 days prior to renewal, we still haven't reached anybody, essentially we do a registered letter to the house saying, hey, you're up for renewal, what's going on? At 2 weeks before renewal, if we've heard from them, that's fantastic. If we haven't heard from them, then essentially we send another registered letter. If we've heard from them and they're going to be paying us off, then it's just a straight refinance and it goes to the lawyers and we do refinance. The money comes back into our trust account. We distribute it out to our investors. Our investors are made whole again, plus they've had their monthly returns that they're getting. And then hopefully we start the process all over again with that new investor and a new file. If the mortgage comes up to a maturity date, we usually give a grace period. This grace period is 15 days from the maturity date, because we know in this time period, or especially in this market right now, appraisers, for example, getting an appraiser out in a timely manner to a property takes time. So, everything seems to be taking a little bit longer than usual or what it was, 3-5 years ago. So, if we're getting refinanced and it's going to be a little bit longer than the process, we do give them a little bit of a grace period to make sure. But then after the 15 days, essentially, they're rolling over into our new terms. Now, if they've been neglectful and haven't, responded to us and they haven't been working with us, then our renewal terms are obviously a little bit more expensive than would be if the client is working with us and has been communicating with us. So it's just how we're proceeding forward from there. If the investor said, I don't want to renew, and the client was not able to refinance and pay us off, after the end of the 15 days past renewal, we do start, a demand letter, foreclosure, power of sale, because essentially now they're in breach of contract. Manufacturing a sale. I promised you I would talk to you about that. We had a property in Hamilton that essentially wasn't selling. We went through a mess of a situation. What I mean by a mess of a situation, the gentleman started missing his payments, but he was good in communication. He was there. He would bring us whole before the end of the month, but it was dribs and drabs, and he was missing his payments. Then he went into a cardiac arrest. Unfortunately, he got hospitalized for 3 months. So 3 months of no payments. So we gave him a little bit of a grace period, and then we, unfortunately, after the 4th month, we couldn't hold off any longer, so we started for a power sale foreclosure. He fully understood and promised to vacate the house. Vacated the house in a somewhat timely manner. We took possession of the home. We did the necessary work that needed to be done on the home. What I mean by that is, we cleaned it out so it looked kind of presentable. Paint on the lipstick on a pig, paint on the walls, cleaned up all the debris, did a dump run, things of this nature. Once we actually got the home, we were able to put it back on the market. We put it back on the market, and of course, situation changed in the market, right? Like, COVID happened, the end of COVID, anyways, whatever. Then the gentleman passed away. So now we're having to deal with the first mortgage. So we brought the first mortgage, we paid out the first mortgage, so we didn't have to worry about the probate or any of that issue. We managed to find a buyer, and the buyer was going to be in a rent to own situation. So they came in as a rent to own. So as a rent to own, so our investor was basically still the lender on the file. We rent to own back to the client. The rent to own transaction was only going to be for a year. After a year of the rent to own transaction, the client was actually making a clean purchase. After that clean purchase, unfortunately, there was still going to be a small shortfall. So our main investor got paid out of the first. Second investor still stayed on in second position for the shortfall. And now they're the second mortgage holder on the file, still proceeding forward. Is there any questions about anything at all? I feel I've been talking nonstop.
What we wanted. No, I just think it's great. I remember looking into lending maybe 10 years ago, and I just feel there's always inherent risk. I just feel like with the quality of borrowers we have now, and with the due diligence that is done on each of these files.
There's definitely inherent risk in every investment situation, whether it's mortgages, stock market, RSPs, whatever the case may be. But it's also, I invest in mortgages because it's what I know.
Not to pivot, but this is more for me. We had talked when I met you last time, just about to be able to leverage things like RSPs to be able to invest.
Absolutely, absolutely. So with not everybody's got liquid cash or so different avenues of how you can invest your money. So to talk about Dave was mentioning about RSPs or secured investments. So for example, you could do a self-directed fund through your RSP. Let's just say, for example, you have $400,000 in your RSP. We could leverage that RSP, put that money out into a mortgage. So the leveraging of your RSP would carry an interest rate, let's call it 5%. We put it out in a mortgage at 10%. Now you're earning an extra 5% on the money you already had earning 5% at your RSP. Putting a line of credit against your home. Any of your clients who have a chip mortgage, they want to pull the money out of who have a home that's free and clear, the elderly, and they're just a little bit weak on their income right now. So we pull the money out in a reverse mortgage where they don't have to make that payment, and then they could put that money out into mortgages and earn a monthly income from that. Or they want to give a gift to their family, but they also are promised that they're going to get it paid back. So maybe we register a mortgage against the property for that gift. There's many different situations and many different ways that we could sort of pull the funds from anybody who's got a little bit better net worth than just straight cash.
Yeah, I always thought that was such a good idea. People don't realize you're sitting on an asset that has all this equity.
Oh, 100%, exactly. If you have $400,000 in an RSP, it's still, we're not pulling the money from the RSP, we're leveraging it, just like you would your home. You leverage your home, you put a mortgage on it, so we're going to leverage the RSP. It's the same idea. So you're still going to earn the original investment income that you would be having with your RSP, but now we basically bump it up a little bit more by putting it out into a mortgage.
And again, when something's secured to your home, and I don't know, the rates are a lot less, as long as the delta, your return is higher than what you're paying.
Exactly. Yeah. I was talking with an investor client just the other day, and he's like, "Oh, it's only going to be a 4% difference." I'm like, "But it's 4% more than what you were currently earning on the same money."
Exactly. As I was saying, when I was looking into this years back, it was, you know, borrowers with credit scores under 400. And
there still are those situations, Dave. Don't get me wrong, but there's also very good clients who just need to get private money. Your clients who are flipping properties, for example. Most of the clients that flip properties or developers or things of this nature, they need the private money. They're good income, good credit, good verifiable everything, but the subject is the issue. For whatever reason, the banks don't want to deal on the subject. cottages, people buying cottages, cabin in the woods. That cabin in the woods may, a lender may only want to go to, 50, 60% loan to value, but the client needs to go to 70. Well, that means their private lender needs to come and play. There's a farm. Banks right now are really only looking at, home plus 5 acres. What I mean by that is the home, 5 acres surrounding the home and not the existing, acreage. You have to qualify special to qualify for the additional acreage. Well, if you don't personally qualify for the additional acres, then you're going on home plus 5. Well, if home plus 5 is only worth $1 million, but your purchase price is 1.5, what are you going to do?
And then there's land again, where most of the major banks will do maybe 50%.
Exactly, yeah. So raw land, you're typically in around 50 to 60%. But having said that, so for myself personally, whenever I've done construction financing, somebody's purchased a piece of land, they're going to build their forever home, their estate home on it. 9 times out of 10, even though private money is on the surface more expensive, in the long run is cheaper. Let me give you a scenario. You're doing your foundation, you're going to the bank for your financing, you're doing your foundation and you run into sand, 20 feet down that you didn't know was there. Uh, you know, your project stops. You got to go do assessment on your sand. You got to go do valuation. That samples then got to go back to the committee. There's got to look at it to make sure that everything is okay. Your environmental's got to be involved, and then once you get the okay, then you proceed forward. You're dealing with an individual or a private lender. Essentially, they come out to the site and they go, "Yep, that's sand," and then you're off to the races. You're moving on again. Right? Like, sure, this piece of that pie may cost a little bit more, but the overall picture and the overall costing of the project would probably outweigh and cost less.
Because I know on the bank side, if you have say you're building your dream house, like the scenario we were talking about, there's phases of the project and funds are released sometimes.
Oh, absolutely. Yeah. So the process is exactly the same. Yeah. They're released in stages. You're given to them in stages. It's going to be construction draws, so usually those draws follow the permit process when you're building a home, so you got your sewers, your water hookup, your hydro hookup, and your foundation would be essentially one draw. Your next would be, your frame and everything in. Then you'd be enclosing your frame, so your roof, your windows, your siding would be in your second. Your interior, so that would be your electrical, HVAC, plumbing. Would be your third, and then before you close out the walls. So essentially, yeah, the process is very, very similar. It's just, ease of where you're getting the money.
Yeah, and just for realtors out there that will be watching this recording too, it's always good to have this kind of a contact like this in your back pocket, when you're dealing with your clients, and because these people are so trained to go the conventional avenues in find.
Absolutely, absolutely. Well, even Dave, just to touch on the training, the banks have trained us to look at 5 years, 5-year mortgages, 5-year fixed, 5-year variables, 5 years. So, CMHC stats are people move, refinance, or have a life-altering event happen in 3. So why are we doing 5 years? Why not go 2-year term, 3-year term? A young couple buying their first home, they're not going to be in that home. Sorry, they're not going to be in that mortgage necessarily for 5 years. They may have a kid in a couple years, outgrow the home. So why not look at a 3-year, for example, as sort of like as a benchmark, and then reassess from that point moving forward. One of the conversations mortgage brokers should have with their clients is sort of, what's your short-term, long-term goal with the home? What's your short-term, long-term goal with your finances? Where are you projecting, where you're going? Not saying that rate is not important, but term and, flexibility within the mortgage are equally as important. So making sure that everything is accounted for. There's good people that are in bad situations and bad people that are in great situations. So you just got to sort of assess every one that comes across your desk and, market it or position it accordingly.
Yeah, I'm definitely as a realtor advising clients, I'm seeing a big shift in banks and the lending. The clients that would
Yeah.
be slam dunk clients, or if you want to call them,
Nothing slam dunk anymore, Dave. Come on.
the amount of red tape or hoops you got to jump through. I don't even do. I have to do. We used to always do 5-day financing. Now we have to do 10, and sometimes we need extensions, even for clients who are ahead of the game or being pre-approved. and all of this. And I notice sometimes on day 9 or 10, the bank then reaches out and says, "Oh, we're going to do an appraisal now." Like, well, we only
Yeah.
may not get an extension.
Exactly. And you never want to put your client in a situation where they're forced to do something, right? You know, yeah, we gotta do what's right for the client in every step of the way.
That's why I'm a big advocate now. As I said, look, don't be so. I find people are so loyal to their banks like it's a social service or something, not a business trying to make money off of it. So that they'd be banking somewhere for 20, 30, 40 years. But I say when your mortgage is up, shop around. And I would say just bring in a mortgage broker.
Yeah, you're absolutely right. That's the bottom line of what a mortgage broker does, is essentially they shop the market to find you the best product to suit your needs. And I know us at Green Lending, for example, if you were at TD and TD was offering a renewal, and I reviewed your file, and I would be the first one if TD was your best option for you, or I felt that TD was still your best option for you to proceed forward. I wouldn't deter you from away from TD. I would say, you know what, stick with TD. That would be the best option. That's kind of our advice. That's what we pride ourselves on, is to do what's right for the client. Having said all that, we we work on referrals. So what that means is, just like yourselves, is if we don't do what's right for the client or we get a bad rep, then essentially that client doesn't refer us business. Like, we really don't advertise. So this is how we build our business, is through referrals and through clients telling more clients about us. So just like yourselves. But I wanted to touch a little bit on compensation, meaning broker compensation, on how we get paid. So for example, if we go to the bank, Scotia, TD, just to name them, then that bank pays us. So there's no cost to the client for our service. If we go to an alternative lender, Home Trust, Equitable Trust, Olympia, a few of the others that are out there, I would say 70% of those alternative lenders also pay us. So again, there's no cost to it. When we're going to take that client to the private sector, that's an entirely different ballgame. But then that would be a conversation that would be happening right out of the gate with the client. Dave, hey, this is our, consultation. This is our review of how we're proceeding forward. Unfortunately, we're going to have to go to the private sector, or I think this would be the private sector would be an option for you, or the best option for you. And then this would be my fee associated with taking you there. And then, so that would be upfront and discussed right out of the gate, so that you, Dave, the client, would be saying, hey, yes, I'm comfortable, or no, I'm not comfortable. And, we part ways at that time.
And then well, I just find that the ones that do pivot from their bank and go to a mortgage broker, the amount of money they end up saving. I don't even think they can pay off principal faster, have things compound, and it can be, we're not talking tens, in some cases, it can be hundreds of thousands of dollars throughout the term of, I guess, a mortgage.
You're absolutely right. And not to talk negatively about any banks, because I do think we need them just as much as we hate them. We need them. But it's not so much as the interest rate or the service cost that is associated with the bank, that actually you realize the cost effectiveness of using a mortgage broker, but it's the exit leaving the bank. So for example, we got the 5 year, we had a life altering event, we need to refinance in year 3. The breakage penalty to leave some of the banks is huge in comparison to leaving some of the monolines. Now, maybe we should touch on the difference between a bank and a monoline. So a bank is like TD or Scotiabank, essentially. So not only do they offer mortgages, but they also checking, savings accounts, visas, lines of credit, personal unsecured, all that sort of fun stuff. Monoline lender. So a monoline lender is a lender who only offers mortgages. So this lender, they're not brick and mortar, they're virtual. They only offer mortgages, and their terms and conditions, or breakage penalty or exits out, 9 times out of 10 are less expensive than would be the bank, but your money is just as secured, because so basically back, we're talking they are getting their money from the bank.
Yeah, because every time I go on those sites to shop around rates, it's always like Butler Mortgage or somewhere like that, like pops up.
Well, Butler Mortgage is Butler Mortgage is a mortgage brokerage, just like Green Lending is. But yes, you're absolutely right. Butler Mortgage is very aggressive in their rate scenario, because they do have the volume that because they spend a lot of money in advertising, so they do have the volume that they're able to satisfy to a lot of the different lenders that are out there.
And then obviously the pro is maybe getting the best rate. But if you can get a good rate through a major bank, It's just, being able to do HELOCs and other things like that. And it being-
Definitely. Yep, 100%.
Yeah, I learned my lesson when I jumped from TD years ago, and now I just keep relationships. I think I have relationships with 3 of the major banks, just in case. Because if you pivot to another bank, they literally treat you like you're a newborn because there's no credit history. And it takes a little
That's the downfall. That's the downfall of going to a new lender or monoline when you've been at like when you've been a client TD Bank for the last 20, 30 years, is the fact that the lender doesn't know you. So they have to, you have to disclose a lot of information. So they may be a little bit document heavy, for example, but not so much that I would say would be a red flag. Excuse me, like for example, if you bank a TD and you have your direct deposit coming into TD, TD's not going to ask you for bank statements. But you go to Scotiabank and you bank a TD, well, then Scotiabank's going to ask you for bank statements. It's the same thing.
I always tell I just when I'm prepping clients, I'm like, just get ready. It's going to seem a little bit invasive, which is the world we're in now.
Unfortunately, and it's positive that the fact that we're all into this virtual world and we actually, DocuSign and things of this nature, but that also carries with it a little bit of negative connotation when it comes into, providing the supporting documentation that is required nowadays. Zoom calls to verify who you are, which is awesome and shitty at the same time, right? Yeah, but you're absolutely right.
Really, that's everything I did have. You covered all the topics I wanted to. I'll
Sure.
touch with you later when I figure out my RSP situation.
Sounds great, David. Looking forward to it.
As I said, I'm going to post all your contact information below, and looking forward to chatting with you again in the future.
Wonderful. Do appreciate it, Dave. Thanks very much.